As of 10:24 a.m. Eastern Time on November 7, 2025, Opendoor Technologies, ticker OPEN, is trading at approximately $5.67 per share. This is not a minor fluctuation. It is a catastrophic intraday collapse, representing a drop of over 21% from yesterday's closing price of $7.23. The market has opened, and investors are hitting the sell button with extreme prejudice. This is the immediate, visceral reaction to the company's third-quarter earnings report, which was released after the bell yesterday. What we are witnessing is the brutal collision of a hopeful narrative with a devastating financial reality. For months, the expectation built by retail investors, the self-proclaimed Open Army, was that Opendoor 2.0 under its new CEO was a turnaround story. This was supposed to be the technology-driven disruptor, a stock many viewed on their Robinhood app as the future of real estate. The reality, delivered in last night's financial statements and forward guidance, is that the company's core business is contracting at an alarming rate. The common belief, which fueled a staggering rally of over 600% in the last 6 months, was that Opendoor had survived the worst of the interest rate hikes. The narrative was that the new chief executive, Kaz Nejatian, who came from Shopify, was refounding Opendoor as a software and AI company. This was the story. It was about a pivot, moving beyond just flipping houses and becoming a high-margin tech platform. Investors bought into this, believing they were getting in on the ground floor of something big. Maybe not the next NVIDIA stock in terms of silicon, but the equivalent for the massive real estate market. The expectation was that the Q3 results would confirm this new direction. But the numbers that just landed have acted as a bucket of ice water. The stock is in free fall this morning because the reality is that Opendoor is not, at this moment, a high-growth AI company. It is still an iBuyer, and the iBuying business is facing a brutal winter. Let's look at the data that is causing this panic. The recent price movement is not just sentiment. It is a direct response to the Q3 earnings, and more importantly, the Q4 outlook. For the third quarter, Opendoor reported a net loss of $90 million. This was wider than the $78 million loss in the same period last year. Revenue came in at $915 million, which was actually above analyst estimates. But here is the catch, and it's the detail that matters. That $915 million in revenue was a 34% decrease from the prior year. The company is selling fewer homes, drastically fewer. They sold 2,568 homes in the quarter, a massive drop from 3,615 a year ago. Even more concerning, they only purchased 1,169 homes. You do not need an advanced degree in finance to understand that if a company's business model is buying and selling, and it buys less than half of what it sells, its inventory is shrinking and its future revenue is set to fall off a cliff. And that is exactly what the company confirmed. The true kill shot in last night's report was not the Q3 results, but the Q4 outlook. Management is projecting that Q4 revenue will decrease by approximately 35% sequentially, meaning from the already low Q3 numbers. This is not a turnaround. This is not a pivot. This is a business in contraction. Management also guided for contribution margins to be worse in Q3 than they were in Q3, and for the adjusted EBITDA loss to widen to somewhere between $48 and $55 million. This is the reality that investors are trading on today. The expectation of an AI-driven recovery has just been completely reset by the reality of a collapsing revenue forecast. This is why you see institutional clients, perhaps those using Fidelity Wealth Management or the sophisticated trading tools at Interactive Brokers, likely exiting their positions, while retail investors who bought into the hype are facing devastating losses. The tension between the CEO's narrative and the company's own forecast is staggering. On the earnings call, the new CEO was emphatic. He said, "We are refounding Opendoor as a software and AI company, and we're not a hedge fund waiting for macro to turn around." He spoke of increasing the velocity of acquisitions, noting that in the last week of October, they were acquiring 230 homes per week, up from 120 in September. But this promise of a recent uptick in acquisitions is completely overshadowed by the official financial guidance for a 35% sequential revenue drop in the coming quarter. If acquisitions are truly accelerating, why is the revenue forecast falling so dramatically? This is the disconnect. This is the gap between expectation and reality that the market is ruthlessly pricing in. The market is signaling that it does not believe the narrative. It believes the numbers, and the numbers are terrible. This stock has been incredibly volatile, a favorite for those using SoFi Invest or other online investing platforms, but it's vital to understand what the company actually does. Opendoor is the pioneer of the iBuyer or instant buyer model. The concept is simple. A homeowner goes to Opendoor's website, types in their address, and gets a cash offer for their home, often in minutes. If they accept, Opendoor buys the house, performs light repairs, and then lists it for sale on the open market. Their income comes from a service fee, typically around 5%, and ideally from any appreciation in the home's value during the short time they own it. This model works beautifully in a hot, low-interest rate market where home prices are always climbing and transaction volume is high. It is a model that breaks, and breaks hard, when mortgage rates skyrocket to 20-year highs as they have. In the current macroeconomic environment, the iBuying model is under extreme pressure. High mortgage rates have frozen the housing market. Affordability is at its lowest point in decades. This means transaction volume, the lifeblood of Opendoor's business, has dried up. Sellers are reluctant to list and lose their low mortgage rates, and buyers are priced out of the market. For Opendoor, this means they buy a house and it sits on their balance sheet. Every day it sits, Opendoor is paying interest on the debt used to buy it, plus taxes, plus insurance. When they finally sell it, the market may have dropped, forcing them to sell at a loss. This is the fundamental flaw. The CEO's talk of AI is an attempt to convince the market they are more like a platform, but their balance sheet and cash flow statements show they are a capital-intensive business tied directly to the health of the housing market. They are a hedge fund, whether they admit it or not, and their bet on housing has been challenged by the Federal Reserve. Wall Street analysts, for their part, have been skeptical of this stock for a long time, even during the massive meme stock rally. Looking at the consensus ratings, the majority of analysts have a hold or sell rating on the stock. The average price target is a stunningly low $1.87. Think about that. Even after today's 21% crash to $5.67, the stock is still trading at 3 times the average analyst price target. This suggests that Wall Street believes the share price has much further to fall. While retail traders on Robinhood stock trading platforms saw a cheap stock and a growth story, the professional analysts using Fidelity ETFs or managing individual brokerage accounts saw a company with a broken business model in a hostile macro environment. The reality is that the stock was, and perhaps still is, completely detached from its underlying fundamentals. So, what is the future outlook here? This is the critical question. The bull case, the one the open army is clinging to, is that the new CEO is right. This is a refounding. He is cutting costs, firing consultants, bringing employees back to the office, and building genuinely useful AI-powered tools that will make the process of buying and selling a home better. The bull case says that Opendoor just needs to survive this housing winter. They need to manage their cash burn and wait for 2026 when interest rates are expected to be lower. If they can emerge from this downturn as a leaner, more technologically advanced company while competitors have gone bankrupt, they could capture an enormous share of the market. In this view, buying today is like buying Apple stock in the early 2000s. It's a high-risk, high-reward bet on a total industry transformation. The bear case, which the market is strongly favoring today, is that this is a company in a death spiral. The Q4 guidance is the proof. The company is in a cash burn trap. To stop the losses, they have to stop buying homes. But when they stop buying homes, their revenue collapses, which causes the stock to fall, which makes it harder to raise capital. The bear case says the talk of